windy Wednesday.
It is Wednesday. True.
I know. I have to
It's all good.
apologize for not meeting with you last week, and today is Wednesday, but as we know, it has absolutely been bananas. So what can you do,
For sure.
I'm going to bring up a screen to share here.
Mm-hmm.
So I wanted to give everybody sort of a market update and kind of go through what's been happening here recently. And I've just sort of been in the trenches, Rick. I mean, holy cow. Like if you want to buy a house in North Orange County, South Orange County, anywhere, there are lines of people waiting to look at houses. We wrote an offer this week for $55,000 over asking. We waived the appraisal and we still didn't get it. And
that's right.
That makes me want to rip my hair out. So here we are. And I want to explain to people why there's so much demand and so not very many houses for sale. And this graph shows it pretty well. Across the United States, it's really sort of the same situation, except for in New York, which is really kind of what we've been reading about, that people were exiting the major metropolitan areas and moving to more rural areas, right? So in California, we have 36% less homes for sale than we did last year at this time. 36%.
Yeah, sounds about right.
And I don't know how much mortgage applications are up, but it feels like they should be up by a whole heck of a lot because, like I said, every house I go to, there's a line of people waiting to go inside and there's multiple offers. But it's interesting to look sort of in the more rural area. Look at this. In Idaho, there is 69% less homes for sale than there were last year. And that was, last year was just right pre-pandemic. Here we are, March 4th, right? Texas, people are swooping those up. Yeah. So this just kind of gives you an idea. Until there's more houses for sale, this trend is going to continue. And my prediction is that we are going to be this way for a very long time. I don't see
I agree.
a whole lot of because people have refinanced. People have over 50% equity on their home.
They do.
Mostly. And they're at a 2.5% to 3% interest rate. They're not going anywhere. The cost of their home is so affordable. And so
that's true.
Yeah, so you really got to be aggressive when you get out there and start looking, because it is just something else. You've got to eat some Wheaties and sort of prepare yourself. And I know the interest rates have gotten a little bit, some changes in the last couple of weeks, and I wanted you to speak on that a little bit.
Yeah, I mean, we're going through a really weird time on rates, and it's not following the normal pattern that it should based on the data that's available. In fact, I read a lot of very good commentary that I pay very good money for, by the way, on the markets. And even the smartest money in the world has not seen, or could not predict this kind of activity. And because it's not really, there's no basis for it necessarily. Perhaps the market's trading out of some sort of emotions, I think, because it's not reacting the way it normally would. But we go through these periods where we have this kind of extreme volatility. And then it somehow finds the bottom, if you will, and it starts working its way back up a little bit. So it will take some time, but look, you got to put that in perspective. I mean, we tend to get spoiled by rates below 3%, and that's really cool when it's happening, right? But the reality is that's not normal. That's just not normal, and so even at around something just north of 3%, we're still at rates that are really near historic lows. And if you look at the history, even recent history, we were this time a year ago, our rates are a half to 3/4 higher a year ago than they are right now.
And the market was still hot. We were on track.
It was still hot then.
Yeah.
Right.
So what's
we
happened?
Put that in perspective.
Yeah. What's happened in the last 6 weeks? Where were we at 6 weeks ago, and where are we at now?
Depends on the loan product, but basically, Megan, we're 3/8 to half roughly higher than we were, 6 weeks ago. We're seeing some signs of the market recovering. The last 3 or 4 days, the market rallied a little bit, which I think we're near the bottom. We're starting to see some recovery back closer to 3% now. Market today took some of that back, which is what you can expect. Here's the deal: it does not move, and it never moves in a straight line, right?
Show us your market watcher.
Yeah, so this is one of the things I look at. Let me just share this with you. And a lot of this is technical stuff I read every day, but this is a graph of today's movement. I'll show it to you if you can see the graph.
Yeah.
This is the movement today. That line there is where the market opened.
Right.
But look at that volatility.
Yeah.
That is it's a lot of volatility. Typically that line is kind of a little bit flatter than that.
Right.
But
right.
that's a lot of volatility in one day. But we've seen a lot of those days recently, right? But it will recover, and it will go back to more of a normal market trading pattern. But for now, we have to just kind of ride this out. I personally think what has to happen for this to change is for the Feds to step in and buy more mortgage-backed securities. Because what that really is, it's an issue of being, liquidity is what it really is. And so as soon as the Feds come in and start buying these securities up, that'll create more liquidity, if you will, and these rates will come back down a little bit some more. So, but again, around 3%, still a great rate.
Yeah, I remember last year when the pandemic first hit, the market went bananas with the rates because the stock market went bananas. Right. And the Feds had to come in and kind of sweep everything off the table and buy everything up so we could start new. And, it's like weird to me, that the government has to come in and buy all the mortgages. It's interesting,
Mm-hmm. A lot behind that.
Yeah, there is a lot behind it. I was just explaining this to somebody yesterday. It's like the whole mortgage-backed securities interest rates, and I know you're very, very proficient in this because you've been doing it for such a long time. I'm getting, over the weekend, I put one of our clients' townhouses up for sale. And great news, I have 14 offers. And
that sounds about right.
Yeah. And so, but I'm looking at some of these pre-qual letters, and the agents send over what is called a DU. It's a desktop underwriter.
Right.
Which I don't need to see because I think it's not legal, but they send it over.
It is not.
Yeah. Right. And so they're showing like a pretty high debt to income ratio. And then I see that they did this 6 weeks ago when the rates were lower. Yeah. So I'm thinking to myself, well, if the rates are higher now and they did this in the middle of January and they were already on the fringe of qualifying in the first place, then what they really should do is get requalified just to make sure.
Yeah, that's a very good point. I did a cross call for another realtor earlier this week, and I called the lender. Honestly, it's almost alarming because I was asking the questions that we should ask to know how qualified they are. And this loan officer had a DU approval, the usual stuff. But when I drilled down a little bit deeper on those numbers, she really did not have an understanding of the numbers at all. And I asked her, I said, so what rate do you have on this? And when did you last run the DU? Well, I think I did that maybe in November, maybe I'll know end of the year. I said, okay, well, what's the rate today? Let's run that DU again.
Yeah.
Came back, refer, not approve. I said, yeah, that's what you're going to get because this buyer doesn't really qualify based on what you've got.
Right.
So here's what we have to do to make this work. I mean, I'm just educating her on what to do, and that's why I feel bad for, as a realtor, you get all these loan approvals, and half the time you have a loan officer that doesn't know what they're doing, or the data is so old that it's not really relevant. And by the way, the DU approval is only as the data in that approval is only as good as what the loan officer inputs to the system. Right. It's not validated. A DU approval is not a validated approval.
Right. I
mean, the only validated approval is when the underwriter reviews the documents and validates it and signs off.
Yeah, like a DU approval, you could have me on the phone as a borrower, and you could be asking me, well, how much money do you make per year? And then you're typing it in.
Right.
Oh my gosh, that doesn't take consideration. It's like gross, net. What are you really writing off? What are you really showing on your tax return?
Right.
Yeah.
Well, you'd be surprised how often, because I talk to buyers every day, they don't really know how much they make.
Yeah.
Until I start asking all the questions and running the calculations, they go, I didn't really know that.
Yeah.
Right. So because how they view the income,
it's complicated.
How they view the income is not always how the underwriter reviews the income. Right.
Right.
And so, but that's a good point. So we always want to do our due diligence on those, but the important thing is keeping those files updated and keeping them relevant and asking all the right questions.
Well, plus it's like, as a borrower, like people are killing themselves to secure a house right now, waiving all of the, appraisal and agreeing to as is and all this kind of stuff. And like, what a bummer that would be if you finally were able to secure a house and then you find out that the rates change. Nobody's prepared you for it. And now it's like an extra $200 a month or something,
Sure.
Like nobody wants that kind of a surprise. So it's important to stay abreast of what is happening and don't get obsessed about it, but just stay in the loop. Don't call your loan officer. Yeah. Don't call them every day and ask them, just kind of be in the loop and understand. And I know you at your hometown lenders, you have the ability to lock the rate while people shop, right? How does that work? What's the process for that?
Yeah, no, it's really cool. So we have the ability to lock the rate for up to 90 days while they're shopping.
Mm-hmm.
And then when we open escrow, if the rate is actually lower, we can what's called a float down. We can float that rate down to the lower rate if that rate is available. If rates have gone up since they locked, then they're good to go with the lower rate. But if the rates have gone down since they locked, we can do that. Now, what makes that unique is this. Every lender in the planet, when they lock a loan, they're hedging that market. They're literally buying a mortgage-backed security, and it's through a hedge. So there's a cost associated with that. If a lender does not deliver that loan at that price, there's a cost to break that hedge, to break that lock. It's not free.
Right.
And so typically the cost is around a half discount point to 5/8 of a discount point to break a hedge. At Hometown, because we do so much volume on a monthly basis, that when at times when we break those hedges and lower those rates, because of the volume that we do, it doesn't really materially impact the cost of our loans nationwide as a hedge.
Yeah.
So we decided to give the buyer the benefit of that lower rate when we can provide it.
I love that.
Which makes good sense.
It's stressful enough. My gosh. Well, good. Well, good talk today, Rick. And we'll have come up with a compelling topic for next week. And if anyone has something that they want us to review, just let us know. We'll be happy to do so.
Very cool.
All right.
All
Talk
good.
to you soon.